Welcome to the podcast that's dedicating to helping business owners to prepare for exit so you can maximize value and exit on your terms. This is the Exit Insights podcast presented by Succession Plus. I'm Daryl Bates-Brownsword, and today I'm talking to Edward Keelan from Octopus Ventures. Hey, thanks for joining me today, Edward.
Absolute pleasure. Great to be here.
Yeah, good stuff. Hey, look, why don't we kick off and just share with the audience a little bit of an insight of what you do at Octopus, and then we can start to figure out what tips and tricks we want to get from you so that we can work best with people like yourself.
Okay, excellent. Yeah, so super quick introduction. I work for a company called Octopus Ventures. Octopus Ventures is part of the Octopus Group. So the Octopus Group, which is £13 billion fund manager, and also has the Octopus Energy arm, which is the energy supply business a lot of people will know about. But Octopus Group is a B Corp, which means that we're not just investing to make a strong profit for shareholders, but also we're thinking about community and environment and other key stakeholders around that. Octopus Ventures itself, we manage around about £2 billion into kind of pre-IPO early stage businesses, and invest in all sorts of interesting stuff: consumer tech, deep tech, fintech. My place in B2B software, which is a bit different.
Excellent. So some of the listeners will have heard of what a VC is, venture capitalist, but maybe being too shy to ask. In simple terms, what is it that you do? You mentioned you invest in companies. Like, how does that work?
So yeah, I mean, venture capital is generally earlier stage growing companies. So the reasons why we provide capital are so that that capital then will help companies expand. So we're not looking at generally investing into highly profitable companies. Hopefully we invest and eventually they become highly profitable companies. At the stage that we're investing often in very early stage revenue. So we've done companies like Kazoo and Secret Escapes, Depop, some really well-known brands. But when we put our money in, it was at a much earlier stage. We take a slice of the equity in order for that investment. And then we kind of work with the company generally over, maybe anything from sort of 3 to 7 years. We'll work with the company, sit on their board. So a big part of what I do is sitting on the boards of companies and helping them kind of through their growth journey. And eventually, if everybody agrees and they want to do an exit, we will then help them through the exit process as well. So, all sorts of different companies, all sorts of different exits. A big part of our role is making sure we maximize that value as investors, but also for management teams. Okay,
so startup and as you said, B2B and software and I think you said geek tech, which I loved. So early stage businesses that look like they're going to go somewhere fast and really need some capital injected into them to leverage that opportunity. But at the same time, you're a B Corp, so you've got some criteria around let's generalize it as doing the right thing. But it sounds like you also act as a bit of a big brother to support them and guide them and sit on their board, the voice of experience, the impartial advisor, looking after your own interests because you've got an equity stake in the business, and when the time comes, help the founders exit.
Yeah, I mean, hopefully our interests are aligned with those founders. I always say, my biggest advice when taking investment is make sure you're taking it from somebody you get on with, because, for the next probably 5 years, they're going to be somebody that's quite important in your life, and you're going to hopefully work together on growing that company, and you're going to take the advice of that investor that you should be able to, because they've seen the scaling journey over multiple companies. So they know they have good networks of people to contact and to prepare you and to hopefully overcome problems. So yeah, hopefully we're very aligned with founders, and ultimately the best results are always where that relationship is extremely strong between founders and investors.
Yeah. So just on that point, it sounds like when founders are talking to yourself, it really pays to be as transparent and honest as you can be about where you're at with the company and where do you want to take it, so that you can find the right match of people to work with them to accelerate that journey.
Yeah, 100%. I think it's a really good bit of advice, but it very much goes both ways. So and I think most VC investors will be transparent on the other part. Like, for example, if we're an evergreen fund at Octopus. We generally manage what they call evergreen funds, which means we don't have a kind of cycle of a fund. It doesn't, often funds are, say, 10 years in length. So they invest for 5 years and then they exit for 5 years. So if you're talking to that fund and they've only got a couple of years left of the fund, well, they're looking for an exit in 2 years. We're an evergreen fund, which means we don't have this kind of time horizon. We just invest, and we may exit in 2 years, we may exit in 10 years. It doesn't really matter to us, as long as with that relationship and the company is moving forward. But as a founder and as the founding team, you need to make sure that what your investor is looking for is aligned with what you're looking for. Because the worst thing would be to end up with an investor that's trying to push you to sell your business, and you're thinking, well, actually, we're 2 years earlier than I want to sell my business. But they're managing a fund that's coming to the end of its life, and it has to try and realize some of those investments. So I would be very clear on both parties what it is you're looking for, because otherwise you're just going to line yourself up for problems in the future.
Yeah, that's a really powerful insight. So Edward, that's about what you guys do. What about for the business owners? Where do they need to get their business to? What does it need to look like? How do they need to prepare before they approach someone like yourself, before they come to you and go, here's my business, to make it a conversation worthwhile, and we're not wasting anyone's time?
So to prepare yourself for investment by a VC, I would say that it really depends on what type of company you are. And this is that, we like to just shove everything in one box and just talk about VC being kind of one thing. But the truth is, it's actually a big and very much a growing market, VC. And whereas historically, venture capitalists tended to be kind of quite generalist in their approach, and they would just do kind of everything. More and more, VCs have become more and more specific in what they're looking for. So, for example, if you're a deep tech, if you're a sort of deep tech company, so our deep tech teams invested in quantum computing and rockets and mind reading technology, and these types of like crazy technology that they're really thinking 7-10 years in advance. If you're that type of company, what you're trying to prepare yourself to is really show your expertise in your IP and why you've got a vision for where you're going to take your product. And it comes all down to the idea and the concept and your ability to really deliver that message to the VC. Now, the other end of the spectrum of VC is where I invest, which is into fairly established, not established, but more established companies that are doing, maybe they've got 2-3 million pounds worth of revenue, and they're doing enterprise software. Now, if you're approaching a VC like me who is looking at this kind of enterprise software, then what I'm looking for is, does this company understand its KPIs? Are the financials in order? Do they have the right personnel? Are they in a market which is growing or shrinking? That's a lot less about just the kind of idea, but the preparation needs to also be about all the numbers and all the data, and have everything having all their sort of ducks in a row and in order. And I think that would be probably the biggest preparation, is to make sure you understand what VC you're talking to, but also don't be disheartened. If you're a drinks company, that's doing really well and growing quickly and in all the major supermarkets, and you come to me, I'm still going to say no, because it's not my strategy. So don't get disheartened at that. You need to try and find the VC that is for you. And so that's about doing a bit of preparation about who you're trying to talk to before you do it.
So what we're saying, by the sounds of it, is that the business it's passed through that startup phase. It's no longer just the founder and a couple of helpers and a number of support staff. We're talking about a business that understands their business model, understands the metrics, has some structure in place, because when you put some investment in, it's going to slingshot growth. So you're making sure that the foundations are in place so that slingshot doesn't destabilize the business.
Absolutely. So what's the most underprepared, I would say, companies that are looking for investment are, it might be a better way of answering it, is quite often say you are a kind of B2B software company that would be right for me and for the team that that I work in, quite often what will happen is we'll get a very nice pitch deck. It will be 50 slides long, the pitch deck, and have full of nice stuff. And then we'll say, well, okay, let's see your financial model. And they'll be, oh, we're still working on the financial model. We're still looking, still kind of perfecting our numbers for the next few years, and etc. To me, that doesn't work. It's like, the first step is to get your financial model nailed. That will give you the answers, which should then go into your pitch deck. It's not to do the pitch deck first and then do the financial model as an afterthought. It always amazes me how many people go for, we invest up to 10-20 million pounds into a company, but even if you're just asking for 2-3 million pounds, it always amazes me you're asking for fairly large sums of money and yet haven't prepared the financial plan properly before you're asking for it. That just seems crazy to me.
Well, it does seem crazy, but at the same time, I'm not surprised, because I've worked with a number of startups, and I think the number of businesses that have started without a business plan and just start on an idea, and that's kind of the entrepreneurial spirit. I think we can make this happen. I've identified a gap in the market, or I've identified a need in the market. We need to do this. We need to get going.
But it comes down to allocation of capital and whether your business model actually works. Because if you're selling widgets for £1 and it's costing you £2 to make them, then you're going to be, you might be growing, but you're going to be losing money.
Yeah.
And I don't think, I'm not a big fan of the 100-page business plan. I think most good business plans can be done on about 10 pages. Yeah. And a decent business model, a decent financial model, doesn't need to be kind of 20 tabs long and blah, blah, blah. But what it needs to show is, okay, what's driving the growth of your business? What's driving your margins, and actually what's going to be, especially in the first 12 months, what's your allocation of capital going to be? Because otherwise, how do you make those decisions? Yeah. You just raise money and then you're like, hey, we've got money in the bank, now what do we do? That's a terrible place for the investor to be, because it's like, well, what happens on day one? You want to actually join, we always talk about it, you want to join a train that's moving, not one that's at the station and ready to start.
Yeah. So we need to demonstrate that we've thought things through, we've tested a few scenarios, we've probably made a few mistakes and refined the processes and bits and pieces. And we've got something that it's not going to be perfect, but we've mapped it out to the best of our knowledge based on some deep thinking.
Absolutely. Yeah. I think that's usually the excuse is, well, financial models are wrong. Anyway, they're always wrong. They never end up being like they are. So therefore it's not worth doing. And my answer to that is always, it's like the idea of a financial model is not to produce a forecast that you end up trying to hit, but to at least for you to be able to make decisions about where to allocate capital and understand what's driving your business. So yeah, I'd completely agree with that. That don't let perfection get in the way of creation. Yeah,
it's almost, I've heard the saying before that goes along the lines. It's kind of not about the plan you've produced. It's about what you've learned along the way of preparing.
Absolutely.
Okay, so we've got a plan, we know our numbers, we know our business model, we've got a pitch deck. What are the deal breakers? What is it if we come to you, you mentioned not having the financials. Are there any other deal breakers out there that you just go, guys, you're wasting my time?
So there are many deal breakers. There are many deal breakers. And I think one of the things, funny, VC is a real positive thing to do, and it's great to invest in companies and see companies flourish, and that's super exciting. And I love working with entrepreneurs, because entrepreneurs are generally passionate people and optimists. Yeah. The problem is the other side of the VC world is that you have to say no an awful lot. The nature of the job is that you say no 99 times and say yes once. So there are often things that many different things. So if we go through them, people. Probably number one. It's a bit of a cliche, but if you come and pitch to me and you're like unenthusiastic, you don't really believe in your product, then chances of me believing it are very limited. Yeah. And I would say, what really scales a company is the ability to get great people around you. So you might be all passion and all the rest of it, but if you come across as arrogant or unengaged or whatever, then that's not going to work for me, because what I want is, can you inspire the next level of people around you to come and join your company? Talent is hard to find. Talent is really, we have our own dedicated talent team at Octopus that does nothing but help companies find their talent. Yeah. But ultimately that talent's going to work for the founder. And if he or she is not going to be able to inspire that next generation, that's really difficult. That would be a real deal breaker. I think people that listen, so the worst thing is in a pitch meeting, you start to play devil's advocate. That's part of our job. And if the founder then gets their back up and tells us why we're being idiots and not listening to us and blah, 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 you think, wow, that's not a relationship I'm going to be able to have, because I'm going to challenge you every single month, multiple times. And if you can't take challenge, then it's probably not going to work for us. And quite often what we'll do in maybe the second or third meeting is actually try and work through a problem together. Try and work through a problem the company's having to get a real insight into the way in which that founder thinks about problems. Other deal breakers is size of the market. That often, do we think this might be a fantastic idea, but if the market is so tiny that it only appeals to a niche set of people, is there adjacent markets that are easy to switch into? Maybe, perhaps, and try and think about it more broadly. But ultimately, if you've got a very specific technology that's only solving one very specific problem, that's probably going to be a deal breaker. And then, complete lack of understanding over the financials, that happens more often than you would believe, not understanding how much does it cost for you to acquire your customers? How much do those customers bring in? What do you charge? What's your average contract value? Okay, and how many times do they churn? How many customers leave every month? Understanding your margins, what makes up those margins. All those things are important.
Lifetime value.
Lifetime value over CAC. All these things.
Okay, so we're really looking for businesses. And if we're talking about tech startups, they should be able to access this information fairly easily, I would have thought.
They should. I think there is a part, I'm always conscious that there's you don't know what you don't know. And you've been in the industry for a long time, and I've been in the industry for a long time. So it becomes second nature to us. But if you're an early stage startup and you've started to get some customers and you're starting to build your business, and somebody says, what's your LTV over CAC ratios? Or, where's your financial model that's driven by marketing assumptions and not by top line growth, and and all these things that second nature to you, they probably go, well, I didn't know what to Google, let alone how to start, which is why, often I'd say if you do come from that point of view, that place, it is worth trying to find some advice. It's worth trying to find people that have done it before and can help guide you through it. In my opinion, just because often you'll only get one shot with a VC. You might get two if you come back in a year's time, but once a VC says no, and you might disagree with their reasons, it's very hard to then convince them otherwise, because by then they've got another 10 pitch decks that have come in. So you're kind of back to the bottom of the queue. So making sure you use that opportunity. What's often useful is to say, find somebody that's connected to a VC and say to them, can I have a friendly chat? Rather than a full pitch, can I just chat and get some advice? That sort of thing.
That's a really good approach, that, Edward, because as you've been speaking, I've been listening a whole lot and going, okay, it sounds a bit like as business owners go on a journey, when they first start the journey, they're full of energy and focus, and they're very directive of the problem they're going to solve, and they work towards heading in that direction. And then 1 or 2 years in, they mature, and then they start to open up a bit, and they pull their head up a bit, just because they can, and they've got room to breathe a bit now. And now they can start to see the questions that they weren't asking before. Just because they didn't have the time, they didn't have the headspace capacity to be working on anything else, but they needed to get this thing moving. Now they've got it moving. Some business owners, what I'm hearing, are able to open up and go, okay, what don't I know? What can other people add to our business? And they sound like the teenage male that have grown out of their teenage years and are now open to input from the outside world and don't have all the answers themselves. Whereas some of us stay as that teenager and are perhaps resistant, reluctant to take on thoughts from the outside to help make our venture even better and robust and resilient than it is at the moment.
Yeah, I was going to say another thing about what really puts me off a business, and actually, especially on the people side, I'd say probably the most thing that puts me off about a business is what I say, or an entrepreneur that's looking for investment, more than anything, is the feeling of that they're dogmatic to their idea. So history absolutely tells us, if you look at almost all successful companies, they look very different today than what they did when they started, or what the concept was. YouTube was a dating video app. That's how YouTube started. Facebook was for universities. Airbnb was about just couch surfing and things like that. Uber was a limousine service. The great entrepreneurs, what they do is not go, I know best and I'm just going to fixate purely on my one idea. The best entrepreneurs go, I'm going to listen to the market. Yes, I'm going to believe in myself and I'm going to believe in my vision for what I'm trying to build, but I'm also going to keep my ears and eyes really open. And if I need to pivot over here, or I need to pivot over there, that's what I'll do. When Amazon started as a book reseller, I'm sure Jeff Bezos was at all times keeping his eyes on what else is around there. How else could we do distribution? How else could we change things? He's not gone, I think this is the model, this is what it be. And if you see businesses that fail, the problem they make is that they don't adapt, they don't change, they don't kind of move with the way that the world's gone. And certainly over COVID, for example, the entrepreneurs that did really well were the ones that lent into the situation, rather than tried dogmatically to stick with their current approach.
So it's pulling your head out and thinking, okay, here's the content of my situation. My solution is really good at solving this problem. What else could, at a contextual level, what else could that be useful for, is what I'm hearing. It's thinking bigger and going, and it's not a literal application. It's how do I really take what I've got here and apply the methodology, the process, the technology, the IP, whatever it is. Where else is this applicable? And if you guys are seeing that people are open like that, you go, well, great, this initial application may be fantastic, but also we're already thinking about how we can take advantage of that application and introduce it to other areas, and therefore everyone benefits from growth and lower costs. The cost is spread over a wider base, or the investment is spread over a wider base.
Yeah, and just listening to that customer feedback loop continuously. Understanding, when you get your early customers and you start to listen to how to improve and adapt and change your product.
Yeah, customers know what they want. I'm just reminded there with my very first client, when I went out consulting, he taught me a sales process. He says, Daryl, if you want to keep customers for a long time, first you've got to sell them what they want. And once you've sold them what they want, then you can help them to sell them what they really need. You've got credibility and respect. Brilliant. Hey, so we've talked about how what you guys do and how to approach a VC and what sort of information and how prepared you need to be when you get there and you're working with the VC. We talked about what not to do. But what are some of the gotchas of working with VCs, or what's going to catch business owners out? What's going to be some of the things that they're not expecting, perhaps?
People, things are not expecting. I mean, during the deal process itself, I would say that it usually takes a lot longer than people realize. It's like, hey, we need to raise investment. Okay, well, let's raise investment this month. It's like, well, actually, with a VC, you're probably going to be chatting for a month. You're going to be then talking term sheets and high-level term sheets for another month, and then to be the deal process. And somewhere between sort of 4 and 6 months, you may raise. I mean, the world has changed, the timelines have come down, but I genuinely think you should probably at least have in your mind, the founder should think it could take us 6 months to raise this capital, and therefore you don't want to have three months worth of cash flow left and go out to raise. The better thing is to have a year's worth of cash flow left, go out to raise, and then be in a much better position in order to give yourself more choice, really, and then more time. I think that the other things that people are surprised with VCs is that the level of control that a VC will want, and that by control I don't mean control over the company. We're backing the founders. We want the founders to go off and build the business in the way that they see it and their vision to see it, and we'll, a supportive investor will support that. But we will often want consent rights. What we can't have is a company, we're investing millions of pounds worth of other people's money. We can't have you decide to go and spend it all on Ferraris and holiday homes and this. And so there's probably a bit more oversight than founders initially think. In terms of the growth story, generally it takes much longer to grow, and a few failed attempts or a few kind of stuttering starts. And we're prepared for that because we've seen so many companies. But most founders will come to us very excited about how quickly their business is going to grow and how amazing it's going to take off, etc. And we'll know it takes a lot longer to hire talent than people think. It takes much longer to build a sales kind of flywheel than people think, and get that kind of marketing and sales link up working well. So things just take longer generally.
And sometimes there's a bit of luck, and sometimes there's a bit of timing. We can have a great idea, but it's just not the right time for the market.
Absolutely. Absolutely. I was trying to think of an example that I had of a great idea that was a bad, that might have been the wrong time for the market. But I was going to say that, I was just talking to a company that does kind of helps businesses manage their kind of virtual business cards, which is really interesting. People don't use business cards anymore, but we're all going back to conferences. So we're all going back to conferences, and we're like sharing LinkedIn. Well, the company can't control how you share contacts over LinkedIn, and if you've got big sales teams, you need to control how people at conferences and things are sharing their contact bases, and that's what this company helps you do. Now, if they'd have started in March 2020, that would have been that business had a great idea, but was not one that was ever going to fly. Whereas now, obviously, we're all going back to conferences in person and sharing details, and no one's quite sure how to do it because no one's got business cards anymore, and they're absolutely on point. So
cool. Okay, and so for a bit of fun, what are the sort of things you shouldn't say to an investor?
Oh, what a great question. What are the things that you shouldn't invest in? Probably things like some of my pet hates are things like, we only need to win 1% of China. So if we just win 1% of China, then we'll be super successful. And actually our forecast show is only winning 0.5% of China or something like that. That is definitely something that I don't like. It's sort of we don't like our pride hurt. So if you used to tell us that the problem is that we don't understand what the problem is, you don't understand my business. I'm like, but that isn't my problem. That's your problem because you're not explaining it to me. Another pet hate is when people talk about, if they've had failure in entrepreneurs that have failed and have restarted, that's fine. Like, I actually don't mind that. You learn a huge amount through failure. But one of my pet hates is that somebody failed and I asked them why did it fail, and it's happened multiple times. They say, well, the problem is the customer didn't understand. And I just think,
not my fault.
Wow. It's like, it was the market, it was the this, it was the that. It was like, no, it was the customer didn't understand. And I'm like, that's not how business works. It's your job to educate the customer, not for the customer to try and have to be educated by you. So there are probably many things, but I try and appreciate that, raising funds and talking to VCs is not the most fun thing in the world for people to have to do. It takes an awful lot of time, and for first time fans it can be quite nerve-wracking. So you try and give people help and guidance. And I think most VCs, I can't speak on behalf of all of them, but I would say most VCs are usually pretty friendly. We're in this because we love entrepreneurs and we love optimism and we love growing companies, and that we're really enthusiastic about it, and therefore we're going to be generally positive. I have heard some horror stories, but I think they're certainly not from Octopus. They're few and far between.
Hey, look, Edward, you've shared some fantastic insights today, and I think you've given a really balanced overview of what business owners need to do and prepare in terms of preparing their business and preparing themselves to have a conversation with someone such as yourself. From your perspective, Edward, what's the key message? What would you really love business owners to take away from that conversation today?
So, I mean, in terms of exit, which I guess is ultimately what your podcast is looking at. So if I would say ultimately in terms of exit, it's very similar to in terms of raising investment. Realize that number one, it's going to take you longer than you think. And number two, the more prepared you are, the better the journey is going to be. The worst thing to do is to go in naively without having got advice from the right people, without really having prepared yourself and prepared your financials, prepared your documents, knowing where you stand and really understanding what drives your business. So yeah, those two things is probably the things, the key takeaways. You can't be prepared enough. Don't go into this process without being prepared, whether that's an exit or whether that's a fundraise. And number two, just be conscious that it's probably going to take you longer than you believe.
Brilliant. Great lessons for life, really. I think those two principles apply more than just this area. Edward, thanks for your time today and sharing with our listeners. I really do appreciate it.
No worries, it's been a pleasure. Thank you.